Hi, I'm Adam, and I'm pleased to be joined by Sam, Steve, and Cheryl. Together, we represent Simon Fraser University as the great portfolio pioneers participating in the sixth annual RBC Rotman Sustainable Finance Case Competition, where we will present our innovative solution.
The 100 million Canadian equity portfolio aims to deliver competitive returns while managing ESG risk for long-term growth-focused investors. It integrates ESG risk scoring with financial metrics, uses proprietary algorithms for portfolio optimization, and adjusts risk metrics with standard financial formulas. A tiered engagement strategy ensures for systemic change. The portfolio achieves 37% lower ESG risk compared to industry benchmarks and consistently outperforms the S&P/TSX Composite Index. To achieve this objective, the fund ensures representation across all major Canadian economic sectors within plus or minus 5% exposure limits. It systemically integrates ESG risks into security selection and quantitative analysis, establishing a clear escalation path for companies failing ESG targets. The fund is designed for growth-focused investors with moderate risk tolerance and a 10-year horizon, only using public equities and benchmarking against the S&P Composite Index. Constraints include a maximum of 10% per asset and ESG metrics assessed via Sustainalytics. Our ESG integration approach starts with materiality-driven risk assessments using third-party ratings and stakeholder analysis. We combine traditional financial metrics with ESG performance data for security selection and utilize proprietary quantitative analysis to optimize portfolio construction by adjusting risk metrics with ESG factors. Additionally, we implemented a tiered ESG engagement strategy to align fiduciary responsibilities with sustainability objectives. Building on our materiality-driven risk assessments, we identify and prioritize ESG issues relevant to financial performance and societal impact. We focus on sector-specific factors, compare company ESG risk scores using Sustainalytics, and assess financial materiality. Continuous review ensures adaptation to evolving market conditions and regulations. This approach aligns with PRI standards, enhancing risk management, stakeholder alignment, and long-term value creation. We use a combination of our ESG integrated approach with securities assessment process. We holistically assess securities by comparing the metrics against industry averages, including price to earnings ratio, price to book ratio, debt to equity ratio, average annual return performance for 1, 3, and 5 year, and Sustainalytics ESG risk score. The Sustainalytics ESG framework helps investors understand the level of ESG risk companies carry by considering factors such as business model, financial strength, geographical exposure, and historical incidents. For example, RBC with a low ESG risk score of 16 is a strong candidate for inclusion in the portfolio, as the average ESG risk score for the financial sector is around 26.8. This comprehensive approach ensures that our portfolio is both financially robust and aligned with ESG principles.
To ensure that we were being as ESG conscious as possible when we were putting this portfolio together, our team created a process that ties financial growth to sustainability and company responsibility. A key component was integrating Morningstar's ESG risk rating with a company's financial performance when we were looking for any potential asset to put in the portfolio. This slide here shows what that process looks like. We start by looking at the trainer ratio to assess what the risk to reward looks like for each equity. Then what we do is we look at the ESG Sustainalytics score, and we use that risk rating to add weight to the trainer ratios. So the higher the ESG risks, the higher the beta goes. The lower the ESG risks, the lower the beta goes. And then to finish it all off, we put all of the numbers that we'd calculated into the program Adam had made for this business case. And the programming essentially spit out the most optimized asset mix for both financial return and ESG performance as well, to make sure that we're getting the most balanced, sustainable portfolio possible. So to illustrate our approach, we're going to look at Suncor Energy as an example. This is, a bad example of what we don't put in the portfolio. They have a high ESG risk rating of 36.8 and, multiple ESG issues. They're known to be very reactive rather than proactive, and that's deterring a lot of investors, especially those that are concerned with the environment. Touching on the environment again, Suncor is entangled in climate litigation and under scrutiny for disclosure practices as well from Greenpeace. And then on the social front, Its workplace safety record definitely raises concerns. Suncor's had over 12 fatalities in 8 years, and that puts them at the highest workplace fatality rate out of any Canadian energy company. So we feel all of these factors are contributing to their high ESG risk rating of 36.8, definitely, and also their elevated beta of 1.47, just showing that they are more susceptible to market volatility. Yeah. On the other side of the fence, Franco-Nevada is a company that is a good actor on the ESG front. Financially, they do outperform. They're 70% over 5 years, and they have a well below market volatility beta of 0.655. Franco-Nevada is very committed to reducing carbon footprint through their sustainable mining practices. Socially, they're investing in communities, hospitals, education. They're also huge on workplace diversity and inclusion as well. We feel that all of these good acts, definitely governance-wise, are leading them to not only have a very low ESG risk score, but also having that very low solid beta as well, indicating that they are a very stable company. So, the two companies that we've looked at, Suncor and Franco-Nevada, definitely highlight how ESG factors can directly tie in and impact financial risk and return. By looking at these ESG risk ratings and being conscious of that when we're constructing our portfolio, we can really enhance the long-term sustainability and performance of it.
So next, we're going to be taking a look at some of the foundational math behind how we generated our portfolio. The beta refers to the volatility or systemic risk of a portfolio relative to the market. So what we did is we developed our own adjusted beta formula that considers the company's Sustainalytics ESG score with an impact factor. And as a result, companies that have larger ESG scores end up having a higher adjusted beta due to that extra risk that they present. So on the right, you can see there's 3 different companies, each with an increasing ESG score, which results in their adjusted beta being increased as well. Next, the Trainer ratio. The Trainer ratio is an industry standard performance metric which measures excess return per unit of systemic risk. So what we did is we adjusted this formula to include our ESG adjusted beta score. What this means is that companies that have low ESG score present less risk in the adjusted Trainer ratio, which allows us to find an optimized portfolio that integrates that ESG score in a very quantitative way. So how did we actually do that? We used an algorithm called SLSQP, which is very useful for solving nonlinear equations that have constraints. And in our case, we have 4 primary constraints. 1, the ESG score must be below 25. 2, it must be a full investment. 3, the sector beta had to be between 0.85 and 1.15. And 4, the maximum weight of the stock was limited, and this was to ensure that our portfolio had diversification. So how this works is we ran 2,000 simulations, and what we did is we identified which sector weights would be optimized using this algorithm. As the simulation runs, the algorithm refines the weights until an optimal solution is found. So as a result, this allowed us to prioritize both the financial performance and the ESG risk at the same time.
We developed an app designed to help us efficiently assess and add securities to our portfolio. With our app, we can seamlessly add stocks by their ticker symbol, and relevant data is automatically pulled from Yahoo Finance to display the key metrics we needed. The app then runs our proprietary algorithm, which optimizes each security by iteratively calculating the ESG adjusted Trainer ratio for each sector within our portfolio. This allows us to construct a portfolio that aligns with both financial performance and sustainability goals. Our results were impressive. We achieved a portfolio beta of 0.89, a tracking error of 4.82, and ensured no individual position exceeded 9.8% of the portfolio. Additionally, the portfolio's ESG sustainability risk score came in at 16.1, demonstrating our commitment to responsible investing. Using historical data, our app calculated portfolio returns that outperformed our benchmark. The annualized average returns were 25.3% over 1 year, 10.3% over 3 years, and 19.7% over 5 years. These results highlight the effectiveness of our app and algorithm in optimizing portfolios for risk, returns, and sustainability.
Our portfolio encompasses a diverse range of organizations across various sectors of the Canadian economy. It includes major financial institutions like Bank of Montreal and Royal Bank of Canada, leading energy companies like Enbridge Inc. and TC Energy Corporation, and prominent industrial firms like Finning International and Thomson Reuters Corporation. The portfolio also includes key players in materials, information technology, consumer staples, utilities, consumer discretionary, telecommunications, and real estate sectors, ensuring broad sectoral representation and balanced exposure. Using the TSX S&P Composite Index as a benchmark, our portfolio with a tracking error of 4.82 ensures representation across all major Canadian economic sectors. The portfolio remains within the plus or minus 5% of the benchmark range for each sector, with actual weights closely matching the TSX composite averages. This strategic allocation provides balanced exposure while effectively managing ESG risk. Our portfolio ESG assessment uses Sustainalytics as the primary tool, setting a maximum acceptable risk of 25, classified as low risk, with a requirement for strong management. The portfolio's average ESG is approximately 16%, significantly lower than the industry average of 26. This results in a portfolio ESG risk score that is about 37% lower than the industry average, demonstrating effective ESG risk management across various sectors.
Our graduated engagement and active ownership strategy is built on the PRI framework, incorporating direct stewardship, collaborative action, and market stewardship. In direct stewardship, we hold quarterly meetings with portfolio companies to address ESG risk and set clear milestones. Proxy voting aligns with PRI guidance. Through collaborative action, we partner with Climate Engagement Canada and academic institutions to amplify our impact and set sector-specified ESG benchmarks. In market stewardship, we advocate for standardized ESG disclosures and engage with the TSX Sustainability Advisory Group. Our tiered approach is straightforward. We identify ESG risks, engage in dialogue, track progress against targets like a 10% ESG score improvement, and escalate if necessary through shareholder resolutions or divestment. We measure success through clear metrics like milestone achievements and ESG risk reductions. The result is a roadmap that drives ESG compliance while balancing fiduciary duty and long term value creation. Our strategy strengths include ESG integration, quantitative optimization, and a TSX aligned sector diversity with tiered engagement. The weaknesses, however, include complex implementation, external data dependency, and potential bias towards low ESG risk companies. And opportunities include growing ESG demand and favorable regulations and industry partnerships. The threats include macroeconomic volatility, increased competition, and sector constraints limiting ESG leader exposure.
So our recommendations are as follows. We recommend implementing sector anchoring, which means maintaining a plus or minus 5% sector exposure versus the TSX, and screening for companies who have an ESG higher than 25. We also recommend using quantitative analysis to generate ESG adjusted beta and trainer ratios. Next, computation optimization can be run to determine optimal sector weights while prioritizing the ESG scores and financial returns. Finally, we recommend implementing a stewardship strategy to maintain high-quality portfolio. There are two things we suggest doing. One is using the tiered engagement system, which progresses from having a dialogue with companies to monitoring their performance and potentially escalation. We also recommend collaborative advocacy, which would entail partnering with organizations such as Climate Engagement Canada. In terms of timeline, we suggest by Q2 of 2026 that we finalize a portfolio with an average company ESG score of 16. And we recommend onboarding 40 more holdings with ESG scores below 25 that have strong financial metrics. By Q3 of 2026, we suggest launching the engagement program and prioritizing 10 companies who have increasing ESG scores. We also suggest integrating with the PRI collaboration platform. By Q4 of 2026, we recommend generating quarterly reports to track the ESG risk reduction and automating the rebalancing of the portfolio with a less than 5% tracking error. What these recommendations will do is they'll maintain quantitative rigor, introduce actionable stewardship, and ensure that we are in alignment with the market with a 10-year growth target in mind. Finally, thank you for your time, and we appreciate this opportunity to present our strategy and our recommendations.